How's it going, everybody? Welcome to our live where we're going to be discussing today the infinite banking concept and your path to wealth, security, and control. Now, it doesn't come in that specific order. It actually means that there's going to be a lot of work on your part. When a lot of times we think about infinite banking, we think about the life insurance policy, but that's a small piece of it.
Yeah. So in today's video, what we want to do is answer all of your questions. Well, not all of them, because there's thousands of questions out there. We recognize that all of you put amazing comments inside our videos, and we notice that a lot of spam is getting to you. So we want you to know that we will never answer your questions inside our YouTube video in the comment section, just because there's so much spam going on and it's kind of hard to sift through all of that. So we will answer everything live for you, or you're always welcome to join the Wealth Nation community so that you can get your questions answered. So what I want to do, did you have something you wanted to say?
Well, speaking of the Wealth Nation community, this is where we got our questions from for today.
Yeah, exactly. So I have a list of questions that we're going to go through. Literally, we're combing through all of your comments inside our video. So let's just jump into it and make sure that we get your questions answered ASAP. So the very first question is, Darius and Carmen, I want to know about the interest. It's a little bit overwhelming for me to understand the interest components when borrowing from my policy.
So this is a really good question because the interest is something that I was a little confused about, because you have interest from the life insurance company, then you create your own interest, so to speak.
Yeah.
So the interest from the life insurance company is going to be, I would say, around 4%. At least that's the interest that we pay for our life insurance policy. Now, the interest that we charge ourselves is going to be the same interest that we would be charged if we were to get this from a third party lender like the bank. Mm-hmm. So, for example, if you were to get a car loan and you did your the pre-approval. You went through the pre-approval process, and it says that your loan would be 7% for your car loan. Then that's the same interest you would charge yourself if you were to borrow from your policy to buy a new car. It's as simple as that. Now, the benefit of this is the fact that the difference of the 4% and the 7%, you're going to pay back to the insurance company, and you're going to keep the other part. Mm-hmm. What's really important about this is the fact that that money that you pay is going back to the insurance company. So you have that money available to borrow, plus the interest that you pay back to yourself, so that in the future you can get a more expensive car. Mm-hmm. Now, here's another thing to understand about interest is the interest that the banks charge you. The longer that interest is outstanding, the longer that loan is outstanding, the more interest you'll pay. So, for example, you can pay 7% interest on a loan for a year, and it's different compared to the 7% interest you would pay over 5 years or 72 months with whatever a normal car note would be. Mm-hmm. Over that period of time, you get to benefit from more interest.
Yeah, absolutely. I just want to shout out Josh Lowe in our comments. What's up, Coach? How you doing? He's a recent member of our Money School family. So welcome, Josh. Thank you for being with us. If you are here watching live, I want to make sure that you all give us a thumbs up, because we are answering your questions live. So what Darius was just alluding to was this interest journey, right? Because a lot of times this can be a little bit confusing with this whole process. So we want to make sure that you understand how the interest works. So like Darius said, quick summary, if our insurance policies, for example, are going to charge us 4% interest to get a loan, we will look for an opportunity to get more interest. So with a car loan, for example, we may charge ourselves 7%, and that delta, the 3%, is what we are going to use to build our banking systems even more aggressively. And there's something called a MEC limit, which is the amount of money that you can put into your policy on an annual basis. You're capped at a certain point. So as long as we have room to put that 3%, that delta, into our policy, then we're going to do so. And we're going to allow that money to grow compound interest time and time again, all day long.
Now, here's a kicker, though, that I want to make sure that everybody understands is if you're able to get a loan for 3%, which is less than the interest that you would get from your life insurance policy, go for the cheaper interest. Mm-hmm. Go for the cheaper interest. Mm-hmm. But the key again is understanding that the more interest that you pay, you're able to keep that difference. Now, also a difference in getting that 3% interest is that once you make those payments are going away from you. Those payments are going away from you.
Yeah.
When you borrow money from the insurance company, you're using your cash that you have available as collateral, and you're still earning interest.
Yes, absolutely. Those are all amazing points that you have to understand along this process. It can get a little complicated, but that's why you join the Wealth Nation community, so that you can be a part of this conversation. So we want to keep going, so we have time to answer some more questions. So the next one is reputable insurance companies that we recommend. This is something we get constantly. In today's market, right? For example, the companies that we write with are Mass Mutual and Security Mutual Life. If you want to do your own research right now, you can look at the letter M, Best. You can Google that, and that is actually the scorecard of insurance companies, their reputations, and how they're doing and how they're performing. So you can always look those up. But for us, we are always scrutinizing companies from a very specific lens, because like I said, we do this ourselves. We'll save some of those details, but the idea is just like, if we're going to write the policies for ourselves, we will write the policies for our clients as well. Because we did run into a situation where we were working with a specific insurance company, and they demutualized, meaning they moved from being a mutual insurance company to a stock company. And how did that affect our clients? Well, it didn't affect our clients in the sense of they had an existing contract. So the insurance company is abided by those contracts, right? But moving forward, if you wanted more policies, then they would be essentially stock policies, if that makes sense. So that kind of alludes into the next question, where someone asked the difference between mutual companies and stock companies. And the big contrast, I would just say, is mutual companies are really for the benefit of the policy holders. Because when you are a policy holder with a mutual company, anytime a dividend is paid out, we get to share those dividends. Whereas with a stock company, we are not owners in the company, and we do not get to share in any dividends or profits in the company. So those are the two main things that I would say. And so for us, we always want dividends coming our way. So that would be the reason why we deal with mutual companies.
Right. And on the topic of dividends, when we create a policy, we have those dividends go back into the policy as cash, so that it buys you more death benefit and increases your cash value. You have another option where you can get that mailed to you as a check. But what we do is we direct those dividends back into the policy, so that, again, you have more cash value and death benefit.
Yeah, and it all happens automatic. Like, we write that in per your contract, so you don't have to worry about it. Now, Dahl, thank you for being with us. I wanted to share your comment. So you said, explain why and what's happening when you pay more interest, which is really just a clever way to buy more paid-up editions. Yes. So you're up on the tee. So yeah. The idea, the idea is we pay ourselves more interest because we want more paid up editions. We want more cash value. So any more money that we add into our policy, that's going to allow us to have more cash, where we can get larger loans every single year, as long as we are continuing to pay more than what it cost us to have our insurance loans. So thank you for sharing that.
Yeah. And another clever way is, the only way we put additional funds into our policies is through the interest. We don't take any of our cash or funds that we have just sitting around and put it in the interest. We only into additional paid up edition. What we do is we take the interest that we earn from our investments or the debt that we're paying off. We put that interest into additional paid up edition.
Absolutely. The next question is, what happens if I am a dual citizen and I am not living in the United States? How do I get a policy? So really, the most common way for you to get a life insurance policy is when you are in the States. So you do have to have citizenship, residency in the United States. So if you are looking to get a life insurance policy on your next vacation back to the States, holler at us. You have to be on soil to take your your medical exam, and to sign your contracts and everything. So just let us know when you have an extended vacation on the States, and we will, in the States, and we will help try to accelerate that process so you can get a policy. Very good questions. We like that. Okay. How do we use policies with businesses?
Now,
this is right up your alley, Darius.
So with businesses, it's very interesting, because like for us as an example, we had to recently get a loan to do a real estate investment with our real estate company.
Mm-hmm.
So what we did is we borrowed the money from our life insurance policy. It went into our separate checking account where we manage all of our insurance policies. Then we transferred those funds from that account to our business. Now that transaction from that account to our business, what we had to do is create what's the contract?
Promissory.
A promissory note. And this promissory note is for our accountant so that he can show that there is a loan being made and not income being made.
Yeah.
So there was a loan being made into the company, and there is a set period of time when that money is going to come back plus the interest.
Absolutely. So there's a lot of details and nuances that go into this whole process. I see a comment in our chat now that says, do we help with this whole infinite banking process? Do we set up policies? Yes. Darius and myself are licensed life insurance agents, and we have a team of 7 other agents who help us. So if you are thinking about being a part of the Wealth Nation family, we welcome you to come, because we all have policies ourselves, all of our team, and we all use this process for ourselves personally and for our businesses. And so we recognize we couldn't do this alone. We were growing very well thanks to all of our amazing viewers and our clients, and we needed support. So that's why we have more agents to help serve our community.
Right. And not just agents. What they have is they have different expertise, where you have some financial advisors that have expertise in real estate, some advisors that have expertise in retirement, like 401ks, stocks, things of that nature. So the whole purpose of us having the information that we have is so that you can be organized when you come and talk to one of the advisors or agents, so that we can help you with your specific need, because everybody's financial situation is different.
Absolutely. Another comment that I see is, what happens if my insurance company goes under? Great question. We get this a lot too. So the idea with life insurance companies specifically and banks, I want to clear up those comparisons. So the insurance companies are regulated on a state level. So that means they have far more regulations than the banks do, because they're regulated on a federal level. And the big difference is that banks basically abide by the ideology of fractional banking, whereas the insurance companies use something called Austrian economics. And what that means is $1 protects $1. So when you think about the grand scheme of things, when the insurance companies are offering all of these policies to you, and they provide a death benefit, whatever you see on your contract is the amount of money that the insurance company actually has to pay you, because they are fined for any death benefit that they are not being able to be paid out to a family. So in order for them to grant you life insurance and for you to sign on the dotted line, means that they know that they have the money on hand to cover you should something happen to you. So you have to take those things in considerations, and it is things that you need to think about, right, when you're considering your money. So for me, in my personal opinion, it would be very, very difficult for an insurance company to go under, knowing the amount of capital that they have to have on hand and the amount of regulation that is backed behind them.
Right. And that's the stark difference between the bank and the insurance company. Is the banks, like Carmen said, don't have all the money on hand. So if there's a run on the bank, which we saw, then there's a possibility that you only get what you're insured, which would be the $250K.
Yeah, that's a good point. The banks have a cap on their insurance, whereas the insurance company has the entire contract.
Because it's insurance.
Right? Yeah, it's insurance.
Go figure. The bank's got insurance.
So can we talk about the MEC limit? We talked a little bit about that before. So the MEC limit is the amount of money that you are capped on in order to be able to deposit into your policy. Because what happens is you pay your premium, right? So this is your premium, and then you may or may not have a little window of additional capital that can go into your policy. So this is where you need, if you're an existing policy holder, that's called a MEC, MEC limit, Modified Endowment Contract is what it stands for. And you may or may not have this limit. We generally try to have a limit, because we know that we are always going to be paying interest back to our policies, and try to fit as much money in that window as possible. So what happens is, if you cross that line, then your policy is going to be taxed moving forward. And there is no way around it. So how we write our policies, it's very important that all of our policies say no MEC, meaning you can't cross the line, and you can't, to try to break the rules. So the great thing about the MEC limit is that it allows you to deposit a little bit more money into your policy to continue to overfund it, and all of that money goes towards that compound interest.
Now, so this would be a good example. If you have additional interest that you've earned from your investment or the debt that you're recapturing, and you want to put additional cash into your policy, then what you'll do is you'll put it towards that additional PUA. And what it does is it increases your death benefit and your cash value available. Now, with that increase in death benefit, so does your MEC limit go up. Your MEC limit also increases because your MEC limit is based on your death benefit, which creates that window between the cash that you are able to, the additional cash that you could put into that policy.
Absolutely. Now, kind of going back to the business conversation that we had before, I see in our live post.
Let me give an example.
Sure.
So I have an American United Life policy. My policy premium was $10,000. When I got that policy, I could put additional $4,000 into that policy. So what I did is I put the additional $4,000 into that policy and increased my death benefit, and my cash value was increased by the amount of money that I put into it. Now, the following year, because I put in additional $4,000, because my death benefit changed, my new MEC limit allowed me to put in $6,000, and it continued to go up because I kept putting additional funds into that particular policy. Now, I no longer put additional funds into that policy because it's not as efficient for me to continue putting money into that policy because my base premium is now producing cash value. That was a lot that I gave you. And as I was talking, I realized that I gave you a little bit too much information.
But you guys are part of the Wealth Nation. You all understand. You've been with us for a long time and you know what's up because you all are asking very complex questions from the comments that we have here and then also inside the chat. So I know you guys are tracking with us. But again, if you don't understand, that's why we created the Wealth Nation community so that you can chat with us offline and all of our infinite bankers so that we can all continue to learn from each other and expound what we know with this whole process, because we know we're always going to be learning this process too. Now, one thing I want to go back to Wayne, we were talking about business and he said, is real estate the best business to set up infinite banking, or are there other preferred businesses? Great question. We tend to always talk about real estate because that's kind of like our thing. But really, Wayne, wherever there is money to be made, you can use your policy. And one example, like for another thing that we do is like, for example, lending money. So real estate is something that we do. Lending money is another. We've lent money for, multiple loans on a variety of different things from cars to, real estate deals to investments to whatever it is. So wherever there is money that is needed, you can do it. And we've used our policies to fund our equipment for YouTube. We used our policies for, any other financing that we need inside of our business. And we just created a contract and paid, those monies back. So it just, again, trying to figure out where is money needed and how can I deploy it?
Yeah. We recently saw in the Money School community where a client purchased a food truck with his policy and he's cash flowing crazily. Is crazily a word?
Yes, today it is.
Significantly.
Today it is. So yeah, just start thinking about ways that you can make money, because when you think about like investments, typically you're always going to use OPM, other people's money, to fund your opportunities. So why not use your policy as the OPM to make this happen? So again, if you're still with us, go ahead and give us a thumbs up. This significantly helps YouTube show us love so that we can reach more people and help the Wealth Nation Million become financially free. All right. So the next thing we were talking about, so MEC limits was another thing, is a front load dump in. And how does that affect the MEC limit? Do you want to handle that one?
A front load dump in, it operates the same exact way. Just with front load dump ins, what you want to do is limit it, because with the front load dump in, what you'll probably have to do is add something called a term rider to your policy. And with that term rider, that term stays on the policy, not just for that first year, but you have to pay for it moving forward. So because what you're doing is basically converting term into whole life. So with that gap, if you don't convert all of the term over, that term is going to eventually come off of your your policy, and it may drag down your policy slightly in comparison to just putting that money in over time.
Yeah. So these are more advanced like policy mechanics. And what I realized many of you may not know is what is a front load dump in. So the example is, let's say that you know that you can afford a premium of $10,000 annually. And you just happen to be sitting on, let's call it maybe $30,000 of capital that you're just saving. You're not doing anything.
You got a tax return and you want to do something responsible with it.
Right.
And you got another, what, 20,000?
Yeah, to dump in, right? So we have the consistent flow of 10,000. We know we can commit to that annually. We just happen to have an extra amount of money that isn't consistent, but we want to add that into our policy. So it's important that we understand all of these nuances prior to you meeting with a member of our team so that we can design a solution that makes sense for you. We're not always saying that it's going to make sense for you to dump in extra money into your policy. Like Darius was saying, it can cause some drag and may not be as efficient for your money long term. But we're going to look at all the options. In some instances, it absolutely is. In some instances, it isn't. And that's all really going to depend on your age, how much money we're talking about, and your insurability. So that's why, again, we have a team of individuals that can help us figure out the best solution for you. But it's just important to know what your options are.
Yeah, everybody's situation is unique. That's why it's important for you to have your ducks in a row so you can tell one of our team members exactly what you're trying to accomplish. Mm-hmm. But for me personally, I never did a dump in on any of our policies. Reason being is I wanted to create that policy around the habits that I had in place of putting that money aside or savings. Mm-hmm, mm-hmm. And the money that we had, we just left it wherever the account was. And if there was an investment to be made, I would mix in that large amount of money with a policy loan. Mm-hmm. That was just my rule of thumb for me personally. For you, it's going to be different. Mm-hmm.
Yeah, I totally see where you're coming from with that. The next question is how long can my paid up additions rider remain on my policy without a term rider? Very good technical question.
As long as you want it to.
Yeah, as long as you want to pay for it.
Yeah. So, for example, like kids, our daughter's policy, we have the paid up addition rider on there for 7 years. The reason being is because kids' policies are a little different, and it takes a little longer for that base premium to start producing cash value. Mm-hmm. So we leave it on there a little longer. Mm-hmm. If you're a little older and you want to keep it on, or if you're older and you want to keep it on there for maybe 5 or 6 years, mm-hmm. because it may take a little longer for your cash value and your premium to match, you may do it in that situation. But it really depends on your situation, and when that base premium starts to produce cash value, that's when we remove the paid up addition, but you can keep it on there as long as you want.
And the other thing to note, so like what Darius was saying, is the rule of thumb that we typically abide by, at least in today's world, right, is that every time you pay your premium, your cash value is going to grow a certain amount. So we're looking at the policies and looking at your illustrations to see at what point does your cash value growth equal the amount of that your premium is on any annual basis. Depending again on your age and your circumstances, that could be between years 4 or years 6 or 7, right? It's just going to depend. So whenever we see that sweet spot where the growth of your cash value is 10,000, for example, and your premium is 10,000, then at that point we will remove the paid up additions rider, and you really only have to pay for the base premium. Now, why do we do this in the first place is because the paid up additions rider really is the instrument that we use to front load your cash value. And we don't want you to have to incur any other cost because really what grows your policy and sustains the policy long-term is the base premium. So from a cost standpoint, we help our clients remove that paid up additions rider when it makes sense to, so that you don't have to continue paying that paid up additions rider. And if you decide to do something else with that money, you have some more money freed up. And then the base premium is just running the show. Mm-hmm. That's really the long and short of it. So let's see. I lost my point here. Sorry about that. Okay. So first off, love your videos. Is it possible to have your bank pay your premium? And when would you consider that?
Now, when it comes to a bank paying the premium for you, that's for people that have significant wealth, because what they're going to do is their premium is going to be like $1 million or more. So when a bank steps in to fund a policy premium for you, that means that there's something in it for the bank. So as we know with the cash value in a policy, we know that the cash value is just as good as cash. So what you're basically doing is you're saying that, okay, I'm going to put only $100,000 on this $1 million premium. And what I'm going to do with the difference of the $900,000, I'm going to invest it. So what the banks do is they fund your premium for you for the next 10 years. And then that cash value, they get their money back from the cash value. And then you have to replace those funds with the investment that you did with the difference. So it's like buying whole life and investing the difference. That's kind of what it is. Mm-hmm. So that difference at the bank finance, they're going to get their money back from your cash value. Mm-hmm. That cash value is no longer going to be there. Mm-hmm. You have to be able to take that difference of what the bank is financing and invest it so that you have that money available when you repay the bank for the money that they fronted you on your premium.
Absolutely. So I'm going to take our last question from Wayne again, who is live with us. I want to make sure that we're able to answer your question live. So the question that you said is, are there certain types of individuals you recommend not doing infinite banking?
Yes.
What a juicy question, yes. Wayne. Excuse me. Go ahead.
So we always talk about the idea of paying yourself first. The reason being is in order to do this concept, you have to have money. And if you don't have any money initially, you're not going to be able to do it. And not only will you not be able to do it, you won't be able to maintain your system. Mm-hmm, mm-hmm. This is all about discipline and habits. Mm-hmm. And the discipline and habits have to be done prior to getting started with infinite banking because you want to make sure that your premiums stay enforced. Yeah. Because this is a long-term deal. And the longer you have it, the more efficient and beneficial it is. Mm-hmm. Yeah. So you have to have that ability, that the habits and discipline set up ahead of time before doing infinite banking.
Mm-hmm. Now, I was laughing, Wayne, because this is such a great question. And I was thinking about like all the people that we've met throughout the years and their dreams and aspirations. And I couldn't agree more with Darius. Like you have to have the habits in place to have good saving practices, because what happens is you have to pay your premium every single year or every single month or every quarter, however you decide to pay your premium. And
even with an outstanding loan, you still have to pay your premium.
Yeah, exactly. So when you know that you have savings, meaning you know that you can pay your premiums and that you have all these other moving parts, you have to have the discipline in place. It's not something that like all of a sudden you're going to get to one day, you start a policy and then I'll get the discipline. Like you have to have the discipline before getting into the policy. And we're laughing because
he's laughing too.
Well, and I'm laughing because we've had personal experiences where we're like, oh, we'll get to it. And then we completely wrecked our system. Right. Mm-hmm. So we're kind of having like deja vu and flashbacks of our own system. So the other thing that I want to touch on is we get all the time is Darius and Carmen, I'm in my 60s, I'm in my 70s. This probably doesn't make sense to me. It makes sense for everybody who has money. If you have money in the bank and it needs to be moved because you want to make more money, it doesn't matter what age you are. You just have to get started with where you are and what you have.
Right. We opened this up with security.
Yeah.
And the money that you have in the bank isn't secured. Mm-hmm. We put it in life insurance because that's what the banks depend on if they don't have the money. Mm-hmm. Insurance. Mm-hmm. So we're just doing the exact same thing. Banks are just middlemen.
Mm-hmm. Yeah, because the whole process, like, and I'm not also saying that like everybody will qualify for life insurance, right? So
because of health, yeah.
So you have to determine first. Let's go down this road to see what my insurability is and see what my options are. And going back to the discipline, I feel like the reason why people aren't successful with infinite banking is because they don't have the discipline. They get their premiums, they borrow immediately from the cash. For some reason, they have it in their head that they never have to pay the loan back. And then all of a sudden they have to continue figuring out how to pay those premiums. And this loan is building, and they have no plan to pay back the loan. And all of a sudden this infinite banking thing doesn't work. So you see where we're going with this. Mm-hmm. So people who are maybe don't have the right information, the right intentions, and don't have the discipline, we don't recommend that they get started until they're ready.
Yeah, the whole point of this is to create cash flow. The banks are able to create cash flow because of the interest that we pay them when we borrow their money. What we're doing instead is we're borrowing the money from the insurance company and they're charging us simple interest annually on whatever we borrow. Mm-hmm. What we're going to do is create cash flow the same way that banks would. And we're going to keep that so that we can continue to put this money someplace where we can make more money.
Absolutely. All right, fam. Well,
there's another question. Can
Peggy,
you apply and get accepted but not start? Will the insurance company not accept again later if you get things in order later? So when you get a life insurance policy, regardless of what company it is, all the insurance companies use the same base information. And they're going to ask you if you applied for a life insurance policy and you didn't move forward or you didn't get accepted. And you have to tell them because they're going to find out. So it's not going to hurt you. You can, in a cover letter, we can say with your agent, you can say exactly why you didn't move forward with it, and you should be fine.
So the thing to note, though, is with that, it does come up, right?
Yeah, it does come up.
If you apply and you don't take your life insurance policy, you do have to explain it. And depending on whatever it is, the insurance company could ding you, right? Because you're applying for insurability, and they want to make sure that you are, what is the word that I'm trying to think of? Consistent, reliable,
yeah.
To be able to solidify a contract. So not that it's like a big deal, but if you do get a contract, you do want to move forward with it. I would suggest it, but always apply. You never know what's going to happen if you apply, didn't take it, because sometimes, life happens, right? So we understand that. And that's what Darius was saying is, if there was some reason why you didn't take it, then you and your agent would write a letter to the insurance company explaining what the circumstance is.
Right. Jay asked the question, what company is the best for the whole life policy that you can borrow from to purchase asset? It's going to be a mutual whole life insurance company. That's the best. If you're in the state of New York, it's going to be Security Mutual Life of New York or New York Life.
Yeah. And we talked a little bit about this earlier, Jay. So for anyone who has similar questions like this, definitely check out the replay. With everything that we do with Wealth Nation, for example, we are life insurance agents. So if you do want to do this process, then we definitely recommend that you click on the link in the description so that a member of our team can help you get this process started. And then if you want to take it to the next level, join our money school so that we can continue to hold your hand through this process and challenge everything that you're doing so that you can continue to elevate your banking system.
Nice.
Now, Wealth Nation, remember to own your own lifestyle.
Or someone else will.
Bye, guys.